Hi, this is Pat Moran from Bright Advisor. We're trying a new segment here called From the Desk of Pat Moran. And what I thought I would talk about is the fact that interest rates went down last week 1/4 point. There's a lot of confusion about what dropping interest rates mean. Most people say, wow, this is great, my home mortgage is going to go down. Mortgages are now in the 3% range, and that has a tendency to stir up interest in buying a home. But it also affects other parts of borrowing too, from credit card debt to car loans to personal loans. A variety of different loans will go down because interest rates went down. Technically, what an interest rate drop is, it's the top banks discounting the rate as far as what they're doing as loaning money on an overnight standpoint. It's the Fed's way of trying to interject more, easier money from a standpoint of creating people borrowing more. People will have a tendency to borrow more because rates are lower. The negative of that is that's a strategy used by the Fed because the economy is slowing. When we're dropping interest rates, it's usually a function of things are slowing down. So by dropping interest rates, they're trying to spur borrowing, which in turn creates more debt. That's a negative that I'll touch upon more. But by borrowing more, spending more, the economy in essence keeps growing. The negative, like I alluded to, is it encourages more borrowing. It encourages more debt. And you have to understand, most debt right now is at all-time high. Credit cards are over $1 trillion. Student loans are well over $1 trillion. As a matter of fact, a lot of people think that student loans and bailing those out might be the next shoe to fall, because about 30% of student loans are in some form of default. Missed payments, late payments, or people just walking away from them, period. The other thing is that we have personal loans, a whole new segment of the economy that's kind of popped up these last 6-7 years, where people are borrowing money in lieu of their paychecks. And that can be a very expensive way to borrow. Fortunately, the government stepped in years ago to reduce those interest rates that you used to hear about at 24, 30, 40% for borrowing in the short term against your future paychecks. Car loans. Car loans right now on average are about 68 months. What that means is that a lot of people are borrowing cars that they can't afford. So what they're doing is they're extending the amount of payments, the months that they're going to make those payments, to make it more affordable so that they can get the car. The average car loan right now is 68 months plus. That's a long time. I remember when car loans, 4 years was the big deal. So we're getting the interest rates dropping, which is encouraging people to borrow. Again, debt rates are very high. I think that over the long term, that can be a negative. The other negative is that when I was in school, it was the old too much money chasing too few goods. When that happened, normally the price of goods and services went up. That creates an environment where we have inflation. Prices start to rise because with more money, more demand, creates more manufacturing, creates more companies building things that can raise prices. As prices raise, now the Fed gets involved to raise interest rates because they're worried about inflation. And what we saw going into this interest rate cut is we had 9 consecutive interest rate rises before we got this cut last week. One of the theories that I want to tell you about and I want to share with you is I feel that if you look back at some of the major corrections in the market, 2008, the tech crash, different things of that nature, 1986 crash, interest rates before that time were always rising, and it had been rising consecutively. And eventually what happens, I feel, is they're risen too much. The market at that point says enough, and what happens is we see these major corrections. So the good news was we had 9, and I was really starting to worry that some of those patterns in the past of consecutive rising interest rates that could ultimately cause the market to drop, we got a little reprieve here with the fact that it went down. And you can always tell what inflation's doing. You can look at what we call the Consumer Price Index, CPI, or the Producer Price Index, PPI. So again, interest rates dropping is a really nice thing for consumers. It's a really nice thing for people that are going to borrow or go into more debt, but it's also a perceived negative because all that debt's got to eventually be paid off. And normally the way we pay off debt on a government level is the next shoe that I'll share with you from the next time in the desk from Pat Moran is the fact that you either reduce revenues, the government gets better at watching their eyes, and the government gets better at controlling its expenses, or raising tax rates. And while interest rates are at a real low right now, guess what else is at a real low? Tax rates. So if I ask most people, what do you think future tax rates are going to do? They're going to say they've gone higher. And historically, taxes have been higher. So we need to be careful, and I want you to put these things into proper context when you see interest rates dropping, or you see potential, maybe taxes going up over the long term. Those things can really affect you in the long term. So lowering interest rates encourages borrowing. As an advisor, makes me nervous. I fear that people are going to go out and go into more debt. And debt right now is really high. I feel that most people should not run out and spend a bunch more money because interest rates went down a little bit. Debt, folks, is going to catch up with you in the long term. We have so many problems with debt right now in this country. We've got consumer debt with student loans at an all-time high. Do you know how many people I've talked about that are struggling with student loans? Well, now with interest rates being a little bit lower, it encourages more borrowing, so student loans can go up. As a matter of fact, did you know last year's freshman class in college is the most indebted group of college freshmen in the country? And it's been going up every year. So as I tell you this, probably this next year's group will be even more indebted. So you really need to make sure that you're watching your budget properly and get back to some of the things that we've preached all along. Knowing your budget, knowing where your expenses are going, because just because interest rates are dropping, it's not a license to go out there and go into a bunch of debt. You still want to manage your expenses, and you want to be responsible with that debt. The other thing is that as an advisor, another fear that I have is eventually lowering interest rates could actually backfire and cause prices to start rising, which means that interest rates can start going back up and getting more expensive. So if you're going to be anything with these lower interest rates right now, really attack your debt, because that's going to mean you're probably paying less interest on your existing debt. As rates fall, all your adjustable loan debt is going to lower. Let's really attack that debt in a meaningful way so that we can be more responsible, be more debt-free, and really start savings and doing the things for retirement or college planning, or paying down our houses a little bit more aggressively, or having an emergency fund. All these things that we preach that are good, responsible things that you should be doing to have a sound financial future and not be stressed out like 78% of other Americans that are living paycheck to paycheck. So if you found any of this useful and you want to go out and run and tell all your friends, I'd love it. But more importantly, if I can help you, go to www.brightadvisors.com, reach out to us, or feel free to give me a call at 602-571-1035, because we're here to help you, here to give you a second opinion, or if you want to get started, let's get started. Thanks for listening today.